In today's fast-paced world, achieving financial freedom is a goal that many aspire to, but few fully understand how to achieve. One powerful way to reach financial independence is by creating passive income. Passive income refers to earnings that require little to no ongoing effort after the initial setup. Unlike the typical active income from a 9-to-5 job, passive income streams provide a consistent flow of cash that can supplement, or in some cases replace, traditional employment. For anyone looking to build long-term wealth, passive income is a crucial strategy. Not only does it give individuals greater financial security, but it also allows them the freedom to pursue their passions and lifestyle choices without being tied to the constraints of a typical workweek. The beauty of passive income is that, once established, it can grow over time, offering a steady stream of revenue with minimal involvement. In this video, we'll delve into 5 proven investment strategies that can help you generate passive income and secure your financial future. These include dividend stocks, dividend index funds, bonds and bond ETFs, real estate investment trusts, REITs, and high-yield savings accounts. Let's explore these strategies in detail and see how they can work for you. 1. Dividend stocks. Earning from established companies. Dividend stocks are shares of companies that return a portion of their profits to investors through regular dividend payments. These payments are often made quarterly or annually and are typically seen as a way for companies to reward their shareholders for their investment in the business. For those seeking passive income, dividend stocks are a popular choice because they provide a consistent income stream without the need for constant management. The key to successful dividend investing lies in selecting companies that have a track record of profitability and financial stability. Established companies that pay dividends tend to be more stable and less volatile than newer, high-growth companies. This is because these companies often have established business models and reliable revenue streams, which enable them to consistently pay dividends. Additionally, companies with a history of increasing their dividends over time offer protection against inflation, as the income they provide grows along with the cost of living. Examples of dividend stocks. For instance, Coca-Cola is a classic example of a company with a strong dividend history. The company has been paying dividends for decades, and it has raised its dividend every year for over 50 years, a hallmark of a reliable dividend stock. Coca-Cola's consistent revenue from its global beverage business allows it to sustain its dividend payments, making it an attractive option for investors looking for passive income. Another example is AT&T, the telecommunications giant. AT&T has long been known for its robust dividend payments, appealing particularly to income-focused investors. Despite the challenges faced by the telecommunications sector in recent years, AT&T has managed to maintain its dividend, providing investors with a steady income. When evaluating dividend stocks, it's important to look at several financial metrics, such as the dividend yield, which is the annual dividend payment divided by the stock price, and the company's payout ratio. A high yield can seem enticing, but it can also be a warning sign if the company's stock price has fallen significantly. A yield that is too high may not be sustainable, especially if the company is facing financial difficulties. 2. Dividend index funds. Diversified income at lower risk. While individual dividend stocks can be lucrative, they come with higher risk because they are tied to the performance of a single company. A safer and more diversified alternative is investing in dividend index funds. These funds are collections of stocks that focus on companies that consistently pay dividends. By investing in a dividend index fund, you automatically diversify your investments across a wide array of dividend-paying stocks, thus mitigating the risk associated with any one company's underperformance. Why choose dividend index funds? One of the main advantages of dividend index funds is that they offer built-in diversification, reducing the overall risk of your investment portfolio. For example, an index fund might include dozens or even hundreds of dividend-paying companies across various sectors like healthcare, technology, consumer goods, and energy. This broad exposure helps to cushion the impact of any downturns in individual sectors, as the other sectors in the fund may still perform well. Another benefit of dividend index funds is the passive management. Rather than needing to research individual stocks and constantly monitor their performance, you can invest in an index fund and let the fund manager do the work. Many funds also automatically reinvest dividends, which can further compound your returns over time. Example of popular dividend index funds. One well-known dividend index fund is the Vanguard Dividend Appreciation ETF, VIG, which focuses on companies with a history of increasing their dividends. The fund tracks the performance of the Nasdaq U.S. Dividend Achievers Select Index, which includes firms with a long track record of consistent dividend growth. Another popular choice is the Schwab U.S. Dividend Equity ETF, SCHD, which aims to provide high current income with a secondary goal of long-term capital growth. SCHD focuses on high-yielding U.S. dividend stocks and can be an excellent choice for investors seeking both income and capital appreciation. When choosing a dividend index fund, be sure to consider the expense ratio, which is the annual fee charged by the fund to manage your investment. Look for funds with low expense ratios to ensure that you are not eroding your returns through high fees. 3. Bonds and bond ETFs. A safe option for conservative investors. For those who are more risk-averse, bonds and bond exchange-traded funds, ETFs, provide a reliable and relatively safe source of passive income. When you invest in bonds, you are essentially lending money to a corporation or government in exchange for regular interest payments, known as the coupon. At the end of the bond's term, you receive the principal amount back. Why invest in bonds? Bonds are generally seen as less volatile than stocks, which makes them attractive to conservative investors or those nearing retirement. Bonds provide predictable income, and the interest payments are usually fixed, meaning that investors can count on receiving regular payouts. Bond ETFs, such as the iShares iBoxx Dollar Investment Grade Corporate Bond ETF, LQD, allow investors to pool their money together to invest in a diversified collection of bonds, rather than purchasing individual bonds. This can help reduce the risk of a bond default and provide more stability to your income stream. Risks to consider. Bonds are typically rated based on their credit risk, ranging from AAA, highly safe, to junk bonds, highly speculative. A higher-rated bond tends to offer a lower yield but is considered safer, while lower-rated bonds tend to offer higher yields but come with greater risk. Bond ETFs can mitigate this risk by providing exposure to a broad range of bonds from various issuers and sectors. 4. Real estate investment trusts, REITs, earning from property investments. If you're interested in real estate but don't want to buy and manage physical properties, real estate investment trusts, REITs, are an excellent option for generating passive income. REITs are companies that own, operate, or finance real estate properties that generate rental income. They are required by law to pay out at least 90% of their taxable income in the form of dividends to shareholders, making them an appealing option for income-focused investors. How REITs work. REITs can invest in various property types, including residential, commercial, retail, and industrial properties. For instance, equity REITs focus on owning and managing properties that generate rental income, while mortgage REITs invest in mortgage-backed securities or offer financing for real estate. Examples of REITs. One of the most popular equity REITs is Realty Income, O, which owns a portfolio of over 6,500 properties, primarily leased to commercial tenants. Known as the monthly dividend company, Realty Income has a reputation for paying monthly dividends to its shareholders, making it an appealing option for those looking for consistent cash flow. For those interested in healthcare, HealthPeak Properties, Peak, is a healthcare-focused REIT that invests in senior housing, medical offices, and life science properties. With an aging population, healthcare REITs can be an attractive investment for long-term growth and income. Benefits and risks of REITs. REITs offer a great way to gain exposure to the real estate market without the complexities of property management. However, they are not without risks. Market conditions. interest rates, and changes in the real estate market can impact REIT performance, making it important to monitor the market and diversify your holdings. 5. High-yield savings accounts. Safe and liquid income. For those looking for a low-risk, highly liquid passive income option, high-yield savings accounts are an excellent choice. These accounts offer a higher interest rate than traditional savings accounts, allowing you to earn more on your deposits without taking on significant risk. How high-yield savings accounts work. These accounts are typically offered by online banks, which can afford to pay higher interest rates due to lower overhead costs. High-yield savings accounts allow you to access your money anytime, making them ideal for emergency funds or short-term savings goals. Examples of high-yield savings accounts. Some popular high-yield savings accounts include those from Marcus by Goldman Sachs and Ali Bank, both of which offer competitive interest rates with no monthly fees. These accounts provide a safe and easy way to grow your money while keeping it accessible. Considerations. The main downside of high-yield savings accounts is that they typically don't provide returns as high as riskier investments like stocks or real estate. However, they are FDIC insured up to $250,000 per depositor, which makes them a safe option for conservative investors. Conclusion. Start your passive income journey today. Creating multiple streams of passive income is one of the most powerful ways to build wealth and achieve financial independence. By leveraging strategies like dividend stocks, dividend index funds, bonds, REITs, and high-yield savings accounts, you can create a steady flow of income that doesn't require constant attention. The key is to get started. Don't worry if you're starting small, every journey begins with a single step. Begin with 1 or 2 strategies, learn as you go, and gradually expand your portfolio over time. The beauty of passive income is that, once set up, it can grow and compound over time, providing you with the financial freedom you desire. Thank you for joining us today. We hope this video has inspired you to take control of your financial future. Be sure to subscribe for more content on personal finance and investing, and share this video with anyone who may benefit from these strategies. See you in the next video.